we're talking about evaluating the performance of an investment center. And you'll remember there are three different measures we can use: ROI, return on investment, RI, residual income, and EVA, economic value added. And we're going to spend a bit of time talking about how do we compute return on investment. And you'll recall that an investment center is responsible for not only the day-to-day operations but policy decisions, tactical objectives, as well as operating objectives of a business. So because of that, we are empowering those managers to make a difference with more than just a budget, revenues, and expenses. We're also empowering them to take some assets and make a difference with those assets. So return on investment is looking at what kind of return did I get on my income statement, my operating income, the bottom line, versus what type of assets I gave that manager to make a difference. And notice it says assets invested. Now, when we're talking about that, since the assets fluctuate during the year, we want to come up with kind of an average. So the assets invested, if we can, will be the average assets invested, which means we'll take the assets at the beginning of the year plus the assets at the end of the year and divide by 2, which will give us a simple average. What we're going to use as an example is we're going to look at problem 4 in our text. And we're going to be doing ROI for problem 4. And problem 4 allows us to do ROI for 2 different years, 2000X8 and 2000X7. And if you look at problem 4, it gives you a balance sheet and it gives you an income statement. And that would basically tell you all the facts you'd need to know about that manager and what they are responsible for their investment center. So let's see what we're going to do. At 2000X7, let's start there. In 2000X7, if I want to find the operating income, I'd go to the income statement, wouldn't I? And the operating income is $43,500. And now how I find my assets invested is I'm going to take my assets at the end of the year, which is $163,900, plus the assets at the beginning of the year, and divide by 2. Now you're saying, well, I don't know what the assets are at the beginning of the year. Yes, you do. It's in the fine print. It tells me that in requirement 1 that the beginning total assets for 2000X5 were $157,900. So if I find the ROI, the return on investment here, I find that it is 27.04%. So hopefully I did my math correctly. Now if I set this up for 2000X8, let's see if we could do it. Again, we're looking for our operating income, not our net income after tax, but our operating income. And where will we go? The income statement. And that is $52,500. And I would divide this by our average assets. So assets at the end of the year, according to the balance sheet, were $173,900. And assets at the beginning of the year are $163,900. Divide by 2. So if I do my ROI correctly, do I find that my return on investment in 2000X8 is, how about 31.08%? So is that better or worse? It's better, isn't it? Now, you'll also recall that our ROI can be broken down into profit margin times asset turnover. So stay tuned and we'll do that.